Hello, I'm Emily Montgomery. Welcome to Stockwatch Live. Now, results are pretty thin on the ground this week, but we've got 3 stocks for you that are all worth keeping an eye on. First up is online fashion retailer ASOS. Yes, company results may be scarce, but the retail sector still likes to make its presence felt. And this time with what I suppose you could call a positive negative. Such is demand for the site's stock that in the second quarter it was unable to physically meet demand in the US. A nice problem to have, you would think, when you consider the fate of so many in the retail sector. But that caused a slowdown in sales and also prompted the company to maintain its previously downgraded guidance on profits. Its US performance, which was behind schedule, is to blame, and that was caused by a higher than expected demand after its Atlanta warehouse went fully online, the company said. This caused a significant short-term dispatch backlog. That's now cleared, and US trading is apparently regaining momentum. Despite that, in the 3 months to 28th of February, total group revenue still managed to rise 13% on the back of retail sales up 13% as well to £641.3 million. Retail gross margins improved too, up 40 basis points. But the announcement sent ASOS shares tumbling because challenging conditions in France and Germany are also still having an impact. The company said it continued to outperform in the UK with sales growth of 14%, while the rest of world segment, excluding Europe, returned to good growth of 20% after a disappointing first quarter. While sales in Europe were also up 12%, France and Germany, its 2 largest markets, continued to be challenging. All in all, it was a mixed picture, so the online retailer left its previously downgraded guidance for 2019 unchanged, with sales growth expected at 15%, retail gross margins expected to decline by 150 basis points, and earnings margins forecast to slip about 2%. Investors will want to know what's being done to face the challenges in France and Germany. One suggestion has been for a change in price and a focus on marketing. Now, just ahead of the half-year results, which are due on Wednesday, broker Citigroup reiterated its buy rating and raised its price target to £52 from £40. But brokers' views differ widely about what the shares are worth. Morgan Stanley remains underweight and has cut its price target from £32 to £22, while UBS is still a buyer and has cut its price target from £75 though to £35. And Goldman Sachs remains a buyer too, but has also cut its price target from £70.90 to £40. The second company to keep an eye on is WH Smith. When you get a flurry of buy recommendations just ahead of a half-year update, it pays to take note. Anyone who's already written off the books, stationery and snack retailer could be missing a trick. While the sight of a WH Smith on the local high street may not inspire much confidence, it's at its airport and railway station outlets where all the action is happening. There is a captive audience whiling away the time before a business flight or jetting off on holiday at the former, and consumers looking for little perks ahead of a long train journey at the latter, which are both keeping WH Smith in business. In January, it said it had seen a 6% boost in sales year to date thanks to buoyant trade at its travel division. In the 20 weeks to January the 19th, total sales in the travel division were up 16%, of which 8% came from InMotion, the US travel business it acquired for about £155 million last autumn. On the UK's high streets, sales though fell 1% in total and 2% on a same-store basis, continuing a long-standing trend. But gross margins increased and the group said it's on track to deliver £9 million of cost savings. Christmas cards, wrap, diaries and fashion stationery all kept the tills ringing over the festive period, the group said. Now, there's no doubt that WH Smith has 2 distinct parts, and to focus on the high street side as a true representation of the whole group is an error. The future of its travel business looks rosy, but the high street side still hangs in the balance to an extent. But the group is refusing to bail altogether, saying it has some stores where it isn't paying any rent at all, so that's not an issue, and that by focusing on its high street offering, selling stationery not CDs and books rather than newspapers, it's increased margins and retained profitability. Trading around £21.20 today, the shares are just off their all-time high. And while they've had a rollercoaster ride over the past year, shareholders who invested 5 years ago have seen their shares rise in value by more than 75%. Peel Hunt has just reiterated its buy rating on WH Smith and raised its price target from £21 to £25. RBC Capital Markets remains at outperform and has raised its price target by £1 to £24, while Barclays Capital retains its overweight investment rating but has cut its price target to £21. The last one is the City Pub Group, which is due to post its full year results on Tuesday. As its name suggests, it's a pub group with locations in London and market towns around the southeast of England. Set up in late 2011 and having started trading in March 2012, it may seem a strange era in which to have launched a chain of new pubs, when traditional pub numbers have long been in decline, and even the new family-friendly, food-orientated ones have been struggling to get customer spending of late. However, the team behind the City Pub Group, which owns a premium, predominantly freehold estate, makes the proposition interesting from an investment point of view. A number of the current board members, including Executive Chairman Clive Watson and Managing Directors Rupert Clark and Alex Derrick, previously ran the Capital Pub Company, an AIM-listed pub company that was sold to Green King for £93 million just before the City Pub Group emerged on the scene. And rumours abound that similar plans could be afoot here. Fuller Smith & Turner, which sold its beer and brewing business to Asahi for £250 million, has cash to spend and is one potential candidate. Its chief executive, Simon Emeny, has said he's keen on expansion via acquisition in the wake of the beer business sale. And even if that isn't the case, the City Pub Group has been trading well. At the start of this year, the group said it remained optimistic about its prospects for 2019 after revealing that trading last year was in line with market expectations. For the 52 weeks to the 30th of December, total turnover was expected to increase about 22% to £45.6 million from a year earlier, and like-for-like sales were up 1.6%. The majority of the growth in 2018 was volume-driven, as price increases were only implemented at the end of 2018, the company said. The price increases are expected to further boost performance in 2019. When it floated in November 2017, the company said it would double the size of its estate, then made up of 34 pubs, by 2021. At the half-year results in September 2018, the group was ahead of schedule on that and now expects to achieve its goal 12 months early by mid-2020. Broker Berenberg rates the shares a buy and has a new price target set at 260p. Liberium Capital, another buyer, has its target at 265p. The shares are currently trading around 215p. Well, that's all for this week. You can follow coverage of the companies as they report in the week ahead on the Markets and Insights section at fidelity.co.uk. See you next time.